Welcome to the Invested Dads Podcast, simplifying financial topics so that you can take action and make your financial situation better. Helping you to understand the current world of financial planning and investments, here are your hosts, Josh Robb and Austin Wilson.
Hashtag testing.
Hashtag testing. Hashtag podcast. Hashtag bros reunion.
Hashtag hot mic.
Hashtag hot. Mic. Hashtag Josh is wearing a mask.
Hashtag
mask mic. Hashtag peach tea. Hashtag coffee. Hashtag Austin has 57% battery.
Hashtag you're just picking things in the room.
All right. Hey. Welcome back to the Invested Dads Podcast, a podcast where we take you on a journey to better your financial future. Today, Josh and I are going to be talking about RISK. Risk.
All right. I love that game. World domination through the roll of the dice.
Man, it's a good game.
Yes.
It's a lot left up to those dice.
It is.
Maybe, I don't know if that's how real politics around the world and global...
Game of chance.
It's a game of chance, no matter how you roll. But actually, Josh, not really the board game Risk, although we should totally play that sometime.
Not only board game, but they have it on your phones now, and you can play people on the phone.
So when you put yourself on
free.
Do Not Disturb in the office, you're actually playing Risk.
I am dominating the world is what I'm doing.
So let's talk about investing risk. So most importantly, your risk tolerance, which we'll talk a little bit, a lot really about what that means today. So according to Investopedia, risk tolerance is the degree of variability in investment returns that an investor is willing to withstand in their financial planning.
Okay, so that's a lot of fun words in there.
I know.
That's a sentence you could say really fast and people will not understand what happened.
But they think you're smart.
Yes.
Buzzwords for days.
So the big one is degree of variability in investment returns. What does that mean?
Okay. So sometimes I'm nerdy. So I'm going to give it two ways. I'm going to do a nerdy one and a simple way. So first, the nerdy one. In terms, I'm thinking of the variability of investment returns kind of as the term volatility.
Yes.
So volatility is essentially the measure of another buzzword, standard deviation for investment returns. So standard deviation is a statistical measurement of how far, either plus or minus, a given historical return is away from its longer-term average. So the higher the standard deviation, which is really the deviation from the mean or the average, the more volatile a holding is expected to be, has been, and really is expected to be going forward. Yep. So to put it simply, it's big return swings. High volatility equals big swings, and that degree of the variability is directly correlated to that volatility there. So those are big up time periods followed by big down time periods. And even though the longer-term average may be the same as something more stable, the swings are therefore bigger, and therefore the volatility and the risk is there bigger.
All right, so variability,
yes.
Variable, meaning there's change, ups and downs. And then the other piece of that is the degree of that. So that's what we're talking about, the standard deviation, which is a fun formula calculation that you and I both had to learn, which is awesome. But that just means, if you have a low standard deviation, it means there's still variability,
right,
but it's smaller.
It's closer to the mean, closer to the average.
Right. So we're saying risk tolerance has to do with the degree or how big the variability, which is the ups and down swings of investment returns that someone is willing to withstand in their financial plan.
And how you take out the noise of having negative swings is you square the number. That's part of the calculation of a standard deviation. Yes. But without getting too nerdy, that's how a big upswing and a big downswing are captured the same way in a standard deviation calculation. Because if you square a negative, it's a positive.
Yes.
And if you square a positive,
still positive.
It's a positive.
Yeah.
Math. So Josh,
Squaring.
I put together an example, and I would like to walk through this example to kind of explain volatility and how that kind of works over time.
And we'll try to put this image in the show notes so people can see what you're talking about.
Yes. So I created this is completely high level and hypothetical, and it's not even perfect, but it still illustrates what I'm talking about pretty clearly. So suppose that you're investing for 5 years, and there are two different kinds of investments. One is a low volatility investment, one is a high volatility investment. So Josh, you have the option of either one of these investments. So I'm going to say you can choose one.
Yep.
Would you choose the one that returns 5% in year one, followed by 6%, followed by 7%, followed by 6%, followed by 5% over those 5 years? Or would you choose the one that loses 5%, and then is up 25%, and then is up 5, 6, and 1%.
Okay. So one spot is pretty, it just kind of walks up and down about 2% is where it goes. The other one starts negative but has some big years and then some average years. Man, those are two totally different investment results from the standpoint of what you get while you're waiting there.
Right.
Doing the math in my head, because I do that.
Yeah, that's what you do.
I would say, the low volatility, because you do get a consistency of returns, will probably give you a pretty good result without having to deal with all those up and down swings.
Yeah, so surprisingly enough, both of those returns over that 5-year period, both of that sequence of returns would get you pretty much the same return, which is amazing.
Yep.
So like, suppose you put $100 bill into investment number 1, which was the low volatility one.
Yep.
You would end up with around $133 at the end. If you put that same $100 bill into investment number 2, or the high volatility one, you would have the same, roughly $133 at the end. So you're averaging about a 6% compound annual growth rate. And that's really, if you would just
wait. Compound annual growth rate. What do you call that? That's Austin's favorite word.
It's a CAGR. And
a
college
CAGR.
students, this is not a CAGR like college CAGR. This is a CAGR as in CAGR.
Real life CAGR.
So this is like if you were to take that rate and extrapolate it for all 5 of those years, that's the number you would get. So I think what you hit on was a very good point of really looking at, first of all, the numbers ended up being the same. And you wouldn't really know that going forward.
Yes.
But those swings are huge.
Yeah.
And really, when you take the fact that I also calculated this, a little nerdy, standard deviation that we had just talked about. So if you look at standard deviation, the low volatility, 5-year period had a standard deviation of only about 1%. Mm-hmm. The high volatility had a standard deviation of about 11%. So drastically more volatile than the low vol example. So when you're looking at risk-adjusted returns, it's a no-brainer to go with investment A, or the low volatility, because you're getting the same return for less risk.
Yep. And risk-adjusted return, that's saying, okay, when we look at what you have to deal with to get to the end result, which one is worth dealing with that hassle? And so coming back to these two examples, if you put in $100 for each of those, at the end of the first year, the first low volatility one had $105 because it got a 5% return. The other one lost $5. And so when you think from a financial advisor standpoint, do I have a client who is risk adverse where losing money will make them change their strategy, get out when they've lost $5 in this scenario, and never have the chance to recuperate it? And so that alone will make it harder to suggest the high volatility one, because I don't want them to leave the strategy before it has a chance to play out. Because again, if you played it all out, you end up with just, a little bit more money, but for having to sit through those ups and downs.
And a common topic in the financial planning world, and one that I'm sure we'll hit on someday in a future episode, is that sequence of returns for retirees, specifically at the end of your saving career, is very, very important.
Yep.
So if you're in something that is, even though your overall long-term average is about the same, that it's a lot more volatile, and you have some of those bad years, not necessarily the up years, but the bad years, either at the end of your retirement, or at the end of your saving years before you retire, or the beginning of your retirement, where you're actually utilizing that income, that can drastically affect your outcome of your results. So, that's probably another topic for another day. But though that sequence of returns can be huge, even though the long-term return is about the same.
Yeah, you could average 5%, 6%, whatever you're showing here. And if you have those bad years at the beginning as opposed to the middle or end, it has a long-term result. So that's risk tolerance. It's the ability to tolerate that up and down swing. Risk, just from a high level, is the chance of that movement, right? The risk is that you could have a fluctuation in your value. So risk tolerance, okay, we got that. Why does that matter? What does that have to do with investing? One
big word: success.
Okay.
SUCCESS. Because there's 2 pairs of 2 letters in there.
That's
success. So staying in your risk tolerance. So if you're okay with more risk or less okay with more risk, staying within the band that you're comfortable with, it's not, it's one of the most important factors in determining your chances of being successful in meeting your long-term investment goals. Wow. I feel like that's been like That's been a really technical and deep intro. So we're going to do a dad joke of the week a little early.
Okay.
So Josh,
I'm ready.
Put on your hat.
I'm on.
We just got out of the COVID-19 bear market.
Bear market.
So if you did not catch that episode, we talked about the shortest bear on record, which it's really a bear market, but I thought it was funny to call it a bear.
Yeah.
Like a teeny bear.
The shortest bear.
Like a short bear.
It's a cub. It's a cub market.
Like Yogi and Boo Boo.
It's a Boo Boo market.
So, Josh, in light of that,
yes,
what do you call bears with no ears?
Bears with no ears. I don't know.
B.
Because they have no EAR. Yes,
B, no ears. EARS.
Yes,
okay.
No, I got it.
So next,
I like it.
Let's get back to it because
yes.
Now you're in a happy mood. You had your dad joke of the week. Why risk matters. Let's talk about that.
Yes. So Austin explained what risk tolerance is and why we need to understand what the tolerance is for each person. Why does that matter? And you said success. So let's break that down. All right. JP Morgan had a chart in one of the things they sent out to advisors that showed some research that was done over the last 20 years. And they looked at mutual fund transactions and found that the average investor over the last 20 years had an annualized return of 2.5%.
That sounds
It's low. Terribly
can't
low.
even talk.
Yeah.
It sounds so bad I can't even talk.
It's a horrible, terrible, and you mix those words however you want. In fact, during that same time frame, inflation was 2.2%. So the average investor earned 0.3% after inflation, or what we call the real return. That's not good.
That's not good at all.
During that same time frame, as a reference point, the S&P 500, so U.S. stocks, returned 6.1%, and bonds returned 5%. All right? And so then the question is, why did the average investor do so bad when kind of the two main assets that people use are up 6 and 5% respectively, and they averaged 2.5? The big factor is reaction to market moves and by selling due to fear. So why does risk matter? It's like you said, the ability to have success in your planning.
Yeah, that's right. So investing above your risk tolerance can have a large impact on your investment returns if it causes you to exit the market while your investments are down. So making those choices, like, for example, we just experienced a bear market.
Yes.
Think the S&P 500 was down 33.5% or whatever. A lot of people may have made very poor choices because they were in things that were too risky for their risk tolerance, and they sold when things were down, and that really impacted you're locking in losses.
Yes.
If you're selling when things are down. Yes. There was a good article from thesimpledollar.com. We'll throw that in the show notes as well, but in this article, they referenced a study that Fidelity did on the impact of missing the best days in the market. So here's what Fidelity found out when they crunched the numbers. On a hypothetical $10,000 investment into an S&P 500 index fund from 1980 to 2018. So you're missing the last year and a half or whatever.
That's 30 years.
Yeah. So what? So your $10,000, if you invested in 1980,
38 years.
Yeah, you invested in 1980 $10,000 into an S&P 500 index fund. Totally hypothetical here, but if you're just in the market the entire time, ride the whole thing out, your $10,000 turned into $708,000.
All right.
That's pretty awesome, right?
That's great.
If you missed the 5 best days of the market, 5.
Okay.
Your what would have been $708,000 if you were in it all the time, you missed the 5 best, your $708,000 became $458,000. That's a big difference.
Wow.
You miss the 10 best days, and that $708,000 turns into $341,000. You miss the 30 best days, that $708,000 turns into $135,000. And if you miss the 50 best days in almost a 40-year period, your what would have been $708,000 if you had stayed in, only was $62,000. That is drastic.
That's crazy.
So
10 missing 5 days.
Yeah.
Resulted in a loss of 35% of what you could have had.
Correct.
That is crazy.
5 days.
And then missing 10 days is half your returns by missing the 10 best days.
Right. So another good reason to stay invested is that the majority of the best stock market days throughout history have come in the midst of significant market downturns. So on top of the 10 biggest days, in terms of gains, 6 occurred during the chaos in the early 2000s during the tech bubble burst, or during the 2008 global financial crisis and outgoing Great Recession that we saw there. So it can be very hard. It's hard for people to get their mind around, but it is crucial to avoid panic selling when the market is having issues and experiencing a lot of volatility, such as we saw earlier this year. So as the saying goes, it's all about time in the markets. So those all the days over that 38-year period versus timing the markets. Because if you start trying to time the markets, you miss those days.
All right. So that's mind-boggling to think that if you miss just those handful of days, how much of an impact it has long-term.
It's huge.
And that those days happen, 6 of those 10 days happen in the midst of the bear market downturn.
Right.
So even though the market's dropping, those few days where you have an up day, which is our big up days, they help cushion your long-term results through that volatility. That's crazy.
So Josh, why can we take risk? Or why should we take risk if there's really chances out there to lose money?
Yeah. Biggest answer is there's no free lunch, right? You hear them say that.
You just said you'd take me out for lunch.
Actually, right now there is, because like school programs have this lunch program, but that's a whole COVID issue. So the saying going, though, is you can't get something for nothing, right? And so if I need returns so what are the returns there for, right? You're saving while you're working and trying to grow your money so that when you retire, that will be sustainable, that you don't need an income source outside of your investments to provide for you for the rest of retirement. And in retirement, you need to continue to invest so that that money can grow or keep up with inflation. So I need some sort of growth, even if I'm done accumulating, to at least keep up with the cost of everything else around me going up in price. So in order to get that return, there has to be some sort of risk involved. All right. That volatility comes, or the return potential comes from the unknown factor of investing, right? When I buy into a stock, the reason why it fluctuates is they don't know the outcome of that company. Will it be here, and will it be the same as what it is right now? Hopefully it's bigger, which means it's probably worth more money and the stock price has gone up. But the unknown is what causes, in a sense, a premium or an additional cost to it, in my sense as an investor, a return on the unknown for lending the money or providing that capital for them to grow.
Yeah, and that's why you see very different rates of required return coming from everything from fixed income, which is very low return rates. The yields are very low right now, but risk is lower, all the way to larger cap, blue chip, stable equities with kind of middle of the road returns, but less volatility. And then things get more volatile, and the rate of return that is required to compensate investors as you get smaller companies or more growth oriented companies gets even bigger.
Or new technology. You look at something like Bitcoin, the chance of return is
very not
unknown.
Guaranteed.
It's unknown. But the risk premium that they're offering, there's a lot of potential. If it turns out to be a new technology that's adopted, there's a lot of return potential. So you're taking a high risk, high return chance with something like that. Again, not recommendations, but those are just some examples of how the more unknowns there are, the higher the risk, which usually means the higher the return potential.
So there are a handful of things that go into calculation of risk tolerance, and those biggest factors are time frame, investment goals, income, and comfort level. So those all play a factor in determining someone's risk tolerance.
Yes.
Age can also play a role, but it's not necessarily as important as your time frame, because say you have, here's an example. Say you have an 80-year-old person. They have a high age, but if their goal is to give money to their grandkids, the time frame is actually a lot longer than their life expectancy. So you may be able to be more aggressive with that portion of the money than a normal 80-year-old person who wants that money to live on or whatever.
Yep.
So Josh, go through those factors a little bit. So start with time frame.
Yeah. So that's why we say time frame instead of age, because age is relying on the person or couple that you're working with. Their age and their time frame, like you mentioned, may not be the same. They may take a bucket approach where each bucket of their money has a different time frame, which means it has a different risk tolerance. So time frame has to do with how long is that money able to be invested without a need on that portfolio, or without that ability, that the unknown of what if I need access to that quickly. The longer the time frame, the more risk you can take. So if I'm a 20-year-old investing in a 401k, because of penalties and all the fun stuff that they have on those plans to encourage you to save, my time frame as a 20-year-old is I can't touch that money without a penalty until 59 and a half. So I have a long time frame to let that money grow. So I should, at least from a risk tolerance standpoint, have a higher degree to accept risk than if I had, maybe I'm a 55 65-year-old looking to retire at 60, my time frame is shorter. But that's just one factor. Investment goals is the next one. So what is this money for? So if I have some money set aside and I'm going to put a down payment on a house, that investment goal and the when am I going to do that, the time frame, impact each other on choosing risk. I may have the ability to say, I don't care what goes on with ups and downs, but if I'm going to need that money in 2 years and it's for a specific reason where I'm going to need the full amount of money, a down payment, my risk tolerance just dropped dramatically for that piece of money. Income is another factor. So again, going back to retirees, if I have other sources of income coming in, my risk tolerance to watch or accept the ups and downs on my investment increases. And so if I have, if I'm working and I have monthly income, I don't have a need or a burden on my portfolio, so my risk tolerance can be higher. You see how all these, there's not one that is by itself, they all interact together. And then the last one is one that's hard to quantify. It's your comfort level. And so this is the one that you take science, which is all these other ones, you can just do a formula. Okay, how much income do I need? What are my investment goals? What is the time frame? What are the standards? What are the needs? All that can be done. Comfort level. We have questionnaires to try to help derive or at least get that conversation going. But the comfort level is more just that conversation with a client and saying, okay, you've been around for a little while. You experienced 2020 and all the fun that's happened so far. What did you feel during that time frame? How did you react? Or if they're new to investing, give them some scenarios and kind of, in a sense, flesh out that thought process of what do I do if I have $100 and in the first year it's down a little bit? What is my response? Because that comfort level can override all those other factors, which we saw in that JP Morgan survey they did, is the average return for the average investor was low, and part of that had to do with the comfort level. They were in things they shouldn't have been in, and they got uncomfortable and were not able to stick it out.
I believe that I'm going to establish a new trademark.
Okay, here we go.
Here on this day. I'm going to say that we measure the comfort level in terms of the, wait for it, cozy coefficient.
Cozy coefficient. I like it.
It's the cozy. So how cozy are you?
How cozy
with
are
what's
you?
going on or what could happen? The cozy coefficient.
And that's probably the most important to keep an eye on.
The cozy coefficient.
The cozy coefficient, because you may not be as cozy during different seasons of your life.
Yeah.
So elections are coming up, if anybody didn't know that. So elections are happening soon. That could change your comfort level. We have conversations with clients whose comfort level is different now than it was a year ago. This COVID-19, that could change your comfort level, having seen and been through stuff. So this is always something to keep an eye on. Yeah, my time frame changes every year. It gets a little shorter for my goals, depending on what they are. My investment goals maintain relatively the same, but they may change in sequence. So I may have a higher need for short-term savings for a down payment for a house, but then that goal changes to retirement savings or college savings or whatever it is. So my investment goals stay relatively the same. Income fluctuates, but is during your working career pretty much consistent in that's providing your safeguard for the need on the portfolio. But comfort level,
wild card.
that is the, anything could happen to change that. It could even be a non-investment event that changes your comfort level for the risk you can take.
Right.
You have a family member you have to start taking care of and they're sick. Okay, that puts pressure on other things in my life, and so my tolerance level just happens to be lower because that's just one less thing I want out of my control. And so we've seen that where those type of things impact it. So it's always important to keep an eye on that.
So we kind of have established risk, what it is, what risk tolerance is, and how that relates to you and how you invest. How do we put together portfolios or plans to kind of meet those risk tolerance levels or cozy coefficients, perhaps,
yes,
that
an
investor may have?
That's your
I'm going
thing.
to stick to that. That's
you're
a
not
cool word. So, Josh, what are some practical, levers that we can pull as people who talk about finance, who manage portfolios, who put things together to help people meet those goals?
Yeah. So first you mentioned knowing your risk tolerance. So it depends on what advisor you have and how they kind of frame that. There's all different ways out there. You can give it from like a term of conservative to aggressive, or there's programs out there that assign numbers to your level of high to low, or all different ways. It doesn't matter how you do it. There's no right or wrong. It's just a matter of understanding where you land on that tolerance, whether it's a term, a number, an asset allocation, but understanding where that is. Once you know that tolerance, what you need to do is build a portfolio. And again, there's so many unknowns. as an advisor, I don't know what the market's going to do in the next day.
Wait, what?
Let alone the next 5-10 years, right?
Yeah.
And so the things you need to do is you need to build a portfolio using historical data, saying what has happened or how has this portfolio behaved, and then extrapolate that forward. Okay, if that's how it's done in the past, will I be comfortable going forward if these similar events happen?
Right.
So a couple things you can do to help keep that in line with your tolerances. The biggest one is diversification. You hear us talk about it all the time. The more diversified you are, the more you smooth your risks out because you're not targeting just one in stock, one asset, one spot that, depending on what that does, your whole portfolio moves.
Not 100% Bitcoin?
Not 100% Bitcoin. And we always say, to know you're fully diversified is to have something in portfolio you're always mad at. That means you're diversified because they should not all move in the same direction. If the stock market's up and everything in your portfolio is up the exact same, you're not diversified.
Yeah.
There should be something doing something a little different, and that's where the diversification comes in. Asset allocation. So we talked about, part of the risk tolerance is how much is in the more aggressive stuff like stocks and how much is in the more preservation side like fixed income and cash and those type of things. Knowing your allocation and what your tolerance is, matching your goals, that's key. And that'll help you. That's the biggest. Diversification allocation really help define your risk tolerance and keeping it in there. But what's also important is as an asset location. So it's not where did I put I buried it in the backyard. No, asset location, and in some assets like stocks do better in like a tax deferred account because if there's a lot of capital gains and turnover and trades, you don't want to be paying that along the way. Whereas a municipal bond that has tax-free income would be good in a taxable account. Exactly. So location means based on all the accounts I have, which piece should be in which account. And so you or your advisor should really think through those pieces as well. After you get your allocation done, that's the second spot. Okay, now I know what I need. Where do I put it? Liquidity. When it comes to risk tolerance, liquidity is important because during the stressful times, like March of this year.
Wait, was that stressful for you too?
I got some gray hairs from that. That is the time where people say, I need some cash.
Yeah.
My company is closing up. I'm unemployed or whatever happens in your life. Liquidity means the ability to get to your cash quickly. And doesn't mean everything has to be extremely liquid, but you should know how much liquidity you have, how quick can I get the cash, and how much cash can I get a hold of.
And that's another plug for another episode that we've talked about doing for a while. Is about an emergency fund.
Yes.
And if you have a fully funded emergency fund and you don't have to pull money out of your investments in crunchy times
when things
like
are down.
March,
yes,
then you'll be better off in the long run. And yes, stay tuned in the future. We will have an episode about emergency fund and what that should look like for different points in your life.
Yes, because it varies throughout your different life stages. A bucket strategy is another way to help bring your risk tolerance in line. And I mentioned that earlier. Buckets meaning each bucket, which is just a term to describe a group of things put together in one spot for a purpose.
It's not like actual
you don't actually
buckets.
you don't put them in them. But so I may have a bucket for my short-term goals. So I'm not going to be risky with that. I may have a bucket for mid-term goals, so things that are happening 5 to 10 years down the road. Then I may have a bucket for long-term goals. Each of those buckets are invested differently so that each of my risk tolerance for that time frame matches. But then my overall, when you take all those buckets together, should not exceed my ability to tolerate that as a whole.
Right.
Because not everybody looks at things as buckets. If you can't draw a line and say this return, if it's down 20%, because it's long term, I'm not going to freak out. Not everybody can do that.
Right.
Whereas, or if you look at the short term and say, when the market's up 32% and I don't get any of that, I'm not going to freak out because that's not what it's here for. You have to fully understand each bucket's purpose. But that is a good strategy for people who do that. Holding weights. So it's not working out. It's like holding weights.
Thought you were looking pretty jacked over there.
Yeah. How much of each of my holdings should be in my portfolio? So when we talk about risk tolerance, let's say I have some company stock and they keep giving it to me and I end up having 20% of my allocation in one stock.
That's a lot.
That's a lot. And that's from a risk tolerance standpoint, what happens to that company, you'll really feel in your portfolio. So knowing how much of any of my one holdings do I want, even cash. Yeah. If I hold 20% cash for a long time, that will have an impact on my portfolio.
Yep.
And so understanding how much weight or what percent of my portfolio should be in each of my holdings is big when it comes to risk tolerance.
Well, that kind of ties into the diversification.
Yeah, it comes back to that. Yep.
Because if you're not diversified if you have too much
Yes.
in any even sectors.
Yeah. And even as good as this does, if you say, well, this company's doing awesome.
Right.
Yeah. But so did some other companies that did great until they didn't. And some people got stuck with a little bit too much. GE is a good example of that.
Hate to be the Enron employee.
Yes. Yeah. And those are the great examples. I mean,
Right.
GE is I think a great story because Enron, they went bankrupt, they're gone.
Yeah.
But GE is still here.
But they're not worth any. Yeah.
But they're not worth anywhere near what they were.
Right.
And the company's still here. It's not like something crazy happened. They just stopped being awesome from a return standpoint, investment standpoint, and people got stuck with a lot of holdings because for the longest time it paid a nice dividend. It grew consistently until it didn't.
So I kind of feel like between all of these different ways that you can build your financial plan, it's like a triangulation. Like it's a lot to put together where you've got to work out diversification and allocation and liquidity and buckets and all making sure your weightings are in line. How do you make sure that those are not getting too out of whack too frequently?
Yeah. So the first one is setting a periodic review and sticking to it. That's huge, whether it's you or what we suggest is having an advisor along with you, someone to help you along with that process. But that's key because things change, and if you're not reviewing it periodically, and when we say that, I can't tell you what the exact time frame would be. Everybody's different, but at least once a year doing a check on how everything is. Some people do it more frequently. Doesn't mean you have to change anything, but you're actively looking at it and saying, okay, how do I feel? How have things gone? Am I still happy with this? So that's the first one, is having the review, having an advisor that you trust. Trust is huge because these are big deals. We just showed you what happens to the average investor if you make some of these wrong decisions. It really mutes your chances of success, especially when it comes to long-term planning. So having an advisor you trust is huge, and making sure they're competent in what they do with their planning. All right, it's not just investing, but it's planning. If you don't have one, we've mentioned before, you can reach out to us. There's a link on our website. If you just want to check out and see kind of how we do things, that's there for you. But regardless of who you use, trust is huge, and having an understanding. Don't just rely on your advisor, all right? They're a human being. They can make mistakes too. Make sure you understand and agree with what is being done in that portfolio.
And as always, check out our free gift to you. It's a brief list of 8 principles of timeless investing. These are overarching investment themes meant to keep you on track to meet your long-term goals, tied directly in with what we are talking about today. It's free. Check it out on our website. Josh, how can people help us grow this podcast and continue to help people?
Yeah, definitely subscribe. That way you'll get an alert every time we drop a new episode on Thursdays. Leave us a review on Apple Podcasts. It's always great. Helps us show up more often in rankings so that other people can find us and be helped just like you guys. If you have any ideas, we love doing topics that people suggest because we know that's something that they're interested in. So send us an idea at hello@theinvesteddads.com. And then also, if you know somebody who was talking about risk tolerance, because it comes up all the time in conversations, then feel free to share this episode with them and let them know that we had a topic and walk through it.
All right. Well, until next Thursday, have a good one.
All right. Talk to you later.
Bye.
Thank you for listening to the Invested Dads podcast. This episode has ended, but your journey towards a better financial future doesn't have to. Head over to theinvesteddads.com to access all the links and resources mentioned in today's show. If you enjoyed this episode and we had a positive impact on your life, leave us a review, click subscribe, and don't miss the next episode. Josh Robb and Austin Wilson work for Hicks & Zerker Capital Management. All opinions expressed by Josh, Austin, or any podcast guests are solely their own opinions and do not reflect the opinions of Hicks & Zerker Capital Management. This podcast is for informational purposes only and should not be relied upon for investment decisions. Clients of Hicks & Zerker Capital Management may maintain positions in the securities discussed in this podcast. There is no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct. Past performance may not be indicative of future results. Indices are not available for direct investment. Any investor who attempts to mimic the performance of an index would incur fees and expenses which would reduce returns. Securities investing involves risk, including the potential for loss of principal. There is no assurance that any investment plan or strategy will be successful.